In 1971, the United States held more than 8,000 tons of gold inside Fort Knox, while the rest of the world trusted every dollar printed in Washington, D.C. Within 2 years of leaving the gold standard, the price of gold climbed from $35 to over $800 per ounce, and nothing was ever the same again. Welcome to the Market Antiquarian, where history and finance reveal how the world really works. Subscribe to stay informed. Long before the United States existed, gold was already warning empires that their time was running out. Ancient Roman soldiers carried gold coins in leather pouches as they marched across stone roads from Rome. Toward the edges of the known world, those same Roman gold coins began doubling in price inside local markets just decades before the Roman legions stopped marching home. Historians studying clay tablets from ancient Mesopotamia found records of gold prices rising sharply before the walls of Babylon fell to foreign armies. The pattern was not random, and it was not a coincidence because gold has always carried a memory that paper money could never hold. Every time a great power began printing more coins or debasing its currency, ordinary merchants in busy marketplaces started hoarding gold instead. Gold sits in a vault in silence, but its price speaks louder than any government announcement broadcast from an official podium. In the 1340s, the Republic of Florence stood as the financial center of the known world, with gold florin coins traded from London to Constantinople. Florentine banking families stored gold bars inside stone buildings along the Arno River, while financing wars for kings across all of Europe. Then the Black Death arrived, and within 4 years the population of Florence dropped by more than half, and gold florin prices doubled overnight. The bankers who had hoarded physical gold bars survived the collapse, while those who held only paper promises lost everything they had built. Across the Mediterranean Sea, in the Ottoman Empire, gold was flowing steadily eastward as silver coins from European mints lost purchasing power every decade. Ottoman merchants in the Grand Bazaar of Constantinople began demanding gold payment instead of silver because they had watched silver lose value generation after generation. When Spanish treasure ships returned from the Americas carrying enormous loads of silver, the value of silver collapsed across European markets almost immediately. Gold responded the opposite way and climbed in value because suddenly there was too much silver and not enough of the metal that could not be easily mined. This was not a modern financial theory, but a lived reality that farmers, merchants, and kings all observed with their own eyes across centuries of trade. The Spanish Empire at the height of its power controlled more silver than any nation in history, yet within 150 years that empire began its long decline. Historians point to the year 1556, when Spain controlled the largest empire on earth, and gold prices in Madrid began their quiet and steady rise upward. By 1620, gold prices across Spanish-controlled territories had more than doubled, and the empire was struggling to pay soldiers stationed along its distant borders. The soldiers in the Spanish Netherlands went unpaid for months at a time, and entire regiments began looting the cities they were supposed to protect. Gold was screaming a warning from inside every vault and every marketplace, but the Spanish crown kept spending and borrowing as though the warning did not exist. The Dutch Republic watched this happen from across the border and made a different choice by building their entire financial system around disciplined gold reserves. Amsterdam became the world financial capital in the 1600s precisely because the Bank of Amsterdam kept honest gold-backed accounts when every other nation was inflating. Merchants from across the world carried their gold to Amsterdam because they trusted that the Dutch would not secretly print more money than they had gold to back. This trust made Amsterdam the wealthiest city in Europe for nearly 100 years and made Dutch merchant ships the dominant force on every ocean route. Then the Dutch East India Company began borrowing far beyond what their gold reserves could support, and the slow and painful contraction began. Gold prices inside Amsterdam markets began rising in the late 1700s, and Dutch financial dominance quietly slipped away across the following decades. The baton of global financial power passed to London, where the Bank of England had been. Established in 1694 with a formal gold-backed currency system, British gold sovereigns became the most trusted coins in the world, and London bankers financed railways, factories, and trade routes across every continent. The British Empire, at its peak in 1870, controlled roughly 1/4 of all the land on Earth and the pound. Sterling was as trusted as gold itself. Inside the grand offices of the Bank of England on Threadneedle Street, gold bars were stacked in underground vaults, and every pound note was redeemable for gold. This system worked because it created discipline and any government that wanted to print more money had to first acquire more gold to back the new notes. The discipline held for decades, and the British pound remained stable, while the economies of continental Europe experienced repeated cycles of inflation and financial panic. Then came the First World War, and Britain, like every empire before it, discovered that war costs more money than any honest gold-backed system can provide. By 1914, Britain suspended the gold standard and began printing war bonds and paper currency to finance trenches dug across the muddied fields of Belgium and France. Gold prices outside official markets began rising, and gold coins disappeared from circulation because ordinary people knew what the disappearance of gold backing actually meant. After the war ended, Britain tried to return to the gold standard in 1925, but set the exchange rate too high, making British exports expensive and uncompetitive. The decision crushed British industry and contributed to the Great Depression, spreading from New York to London and then outward to every corner of the global economy. In 1931, Britain finally abandoned the gold standard permanently, and the pound sterling began its long, slow decline from the most trusted currency to just another national money. Across the Atlantic Ocean in the United States, gold was telling its own story that very few people in power wanted to listen to in those years. The United States had emerged from the First World War as the largest creditor nation on Earth, with more gold flowing into Fort Knox than any other vault. American factories had supplied both sides of the war with weapons, food, and materials, and demanded payment in gold, pulling enormous reserves away from European nations. By 1945, the United States held more than 70% of all the official gold reserves in the entire world inside its vaults at Fort Knox in Kentucky. Fort Knox was not just a building, but a symbol of total economic dominance, and every other nation had to acknowledge that American gold made the rules. At the Bretton Woods Conference in New Hampshire in 1944, representatives from 44 nations gathered at the Mount Washington Hotel to design a new global monetary order. The agreement they signed made the United States dollar the world reserve currency and promised that every $35 could be exchanged for 1 ounce of gold. This promise was made by men in suits sitting around polished tables in New Hampshire, while soldiers were still fighting in France and across the Pacific Islands. The promise was credible in 1944 because the United States had the gold to back every dollar, and no other nation came close to matching that reserve. For nearly 2 decades, the system worked, and American factories, farms, and corporations exported goods to a recovering world, while gold stayed safely in Fort Knox. Then came Vietnam and the Great Society social programs, and the space race, and suddenly the United States was spending far more than its gold reserves could justify. President Lyndon Johnson, standing in the White House, signed spending bills totaling hundreds of billions of dollars, while gold reserves began declining in Fort Knox year by year. European central banks noticed the numbers first and began quietly exchanging their dollar reserves for gold at the official $35 rate before the window closed. French President Charles de Gaulle sent a French naval ship to New York City to collect gold from the Federal Reserve vaults on Liberty Street in Lower Manhattan. De Gaulle stood before French television cameras and declared that gold was the only real money and that France would not trust a paper promise from Washington, D.C. Between 1958 and 1971, the United States lost more than half of its official gold reserves as foreign governments rushed to convert their dollars into physical gold bars. The gold was leaving Fort Knox and the vaults at the Federal Reserve Bank of New York, and the outflow was accelerating with each passing quarter of the fiscal year. President Richard Nixon sat in the Oval Office in the summer of 1971, watching the numbers and understanding that the gold window could not stay open much longer. On the evening of August 15th, in 1971, President Nixon appeared on American television screens across the country and announced that the United States was closing the gold window. The camera captured Nixon sitting behind his desk in the White House, while he told the world that dollars would no longer be exchangeable for gold at any price. In trading rooms across London, Tokyo, Zurich, and Frankfurt, currency traders stared at their screens and began making calculations that would reshape the global financial system. Gold, which had been locked at $35 per ounce by government, decree began trading freely and climbed to $44 within days of the announcement. By 1974, gold was trading at $187 per ounce, and the world was watching a metal deliver a verdict on a decision made by one man in one evening. By 1980, gold reached $850 per ounce, a price that represented a 2,300% increase from the official government price of just 9 years earlier. People who had stored gold bars in private vaults or coins in safe deposit boxes watched their wealth multiply, while those holding only cash watched their savings erode. The inflation of the 1970s was not simply bad luck, but the direct mathematical consequence of removing the discipline that gold backing had imposed on government spending. Grocery store shelves in American cities showed price tags being changed weekly because the purchasing power of the dollar was falling faster than stores could reprint menus. Gasoline lines stretched around city blocks in 1973 and again in 1979 as the dollar lost. Credibility and oil-producing nations demanded more dollars for the same barrel. The connection between gold leaving Fort Knox and gasoline lines wrapping around filling stations in Cleveland and Houston was real, but almost nobody explained it on the evening news. Paul Volcker became chairman of the Federal Reserve in 1979 and walked into a Federal Reserve boardroom in Washington, D.C. to face one of the worst inflation crises in modern history. Volcker raised interest rates to nearly 20% and allowed the American economy to enter a severe recession in order to restore confidence in the dollar. The medicine was painful, and unemployment lines stretched around government buildings in industrial cities, but the inflation finally slowed and the dollar stabilized by 1,982. Gold fell from its peak of $850 back toward the $300 range as Volcker demonstrated that discipline could be restored even without a formal gold standard. The lesson of the 1970s and 1980s was that gold was not simply a relic but a disciplinary force, and when that force was removed, the consequences were measurable and severe. Economists sitting in university offices began writing papers arguing that modern central banking could replace gold, but the historical record was already full of contrary evidence. Every empire and every great financial power that had removed gold discipline from its monetary system had eventually experienced the same sequence of inflation, debt, and decline. The Roman Empire debased its silver coins and lost territory. The Spanish Empire flooded markets with silver and collapsed. Britain suspended gold backing and began its long retreat. And now the United States had voluntarily removed the last formal link between its currency and gold. And the question that historians would ask was whether this time would be different. Central banks around the world continued holding gold bars in their vaults, even as economists argued in academic journals that gold was an outdated and irrational choice. The German Bundesbank kept its gold in vaults in Frankfurt and New York City and refused calls to sell it, citing historical experience that Germans had learned the hard way. Germany had lived through hyperinflation in 1923 when a wheelbarrow of paper marks could not buy a single loaf of bread in a Berlin bakery shop window. German memory of paper money failing was burned into the national consciousness, and that memory kept German gold reserves intact through decades of economic theory arguing otherwise. In the decades after 1971, global debt began a climb that had never been seen in the entire recorded history of human civilization, and its pace was accelerating. Government debt, corporate debt, and consumer debt all expanded simultaneously across the United States, Europe, and eventually across every nation connected to the dollar-based financial system. The total global debt reached $100 trillion by 2010, then $200 trillion by 2020, and projections showed no natural ceiling anywhere on the horizon of financial planning. Gold sat in underground vaults, watching these numbers grow, and the price of gold began rising again, climbing from $255 per ounce in 2001 toward new records. By 2011, gold had reached $1,900 per ounce, and the financial world was beginning to ask a question that the historical record had already answered many times before. When empires remove the discipline of gold from their systems and debt begins its climb toward the sky, gold does not stay silent for very long. In 2008, bank doors across Wall Street closed as financial institutions holding trillions in mortgage debt began collapsing one after another in Lower Manhattan. Lehman Brothers employees carried cardboard boxes out of glass office towers in Midtown New York City on September 15, 2008, as the firm filed for bankruptcy. The United States government faced a choice inside Treasury Department offices in Washington, D.C. that would change the relationship between gold and the dollar permanently. Federal Reserve Chairman Ben Bernanke sat before cameras in a Washington, D.C. hearing room and told lawmakers the financial system was days away from total breakdown. Congress approved a $700 billion bailout package, and government printing presses began, running faster than they had at any point since the Second World War. gold bars sitting in private vaults and central bank reserves around the world began rising in price the moment the bailout bill passed through the halls of Congress. The Federal Reserve balance sheet stood at approximately $900 billion before the 2008 crisis, and within 2 years, it had climbed past $2 trillion. Printing presses at the Bureau of Engraving and Printing in Washington, D.C., worked around the clock, producing new dollar bills to feed the expanding money supply. Gold responded exactly as it had responded to every empire that had chosen printing over discipline, and the price climbed from $800 toward $1,000 per ounce. Ordinary Americans watching evening news broadcasts in living rooms across the country saw their retirement accounts shrink while gold prices appeared on the screen, climbing upward. Central banks in China, Russia, and India began buying gold bars in quantities that had not been seen since the years following the Second World War. The People Bank of China in Beijing quietly added hundreds of tons of gold to its reserves between 2008 and 2015, while publicly saying very little about the purchases. Russian gold reserves stored in central bank vaults in Moscow grew from approximately 200 tons in 2007 to over 2,000 tons by 2018 as Russia reduced its dollar holdings. These were not small transactions, but massive strategic decisions made by governments that had studied the same historical record and reached the same historical conclusion. Gold was not being bought by nervous individuals alone, but by the treasuries and central banks of nations that controlled armies, navies, and nuclear arsenals. By 2011, gold had climbed to $1,900 per ounce, and financial television screens in New York, London, and Hong Kong were filled with analysts debating what it meant. The Federal Reserve announced a program called quantitative easing, in which it purchased trillions of dollars of government bonds, expanding its balance sheet without limit. Bond traders on Wall Street watched the Federal Reserve purchase mortgage-backed securities and treasury bonds in quantities that dwarfed anything attempted in prior decades. Gold pulled back from its 2011 peak as the dollar temporarily stabilized, and many analysts standing before television cameras declared that the gold rally was finished. But the structural conditions that had driven gold upward had not changed, and the debt that governments around the world were accumulating was continuing to grow every quarter. United States national debt crossed $10 trillion in 2008, then $15 trillion by 2011, then $20 trillion by 2017, and the trajectory showed no sign of reversing. Each time the national debt ceiling was debated inside the chambers of the United States Capitol building, the ceiling was raised and spending continued its upward path. Economists on opposite sides of the debate filled lecture halls at Harvard University and the University of Chicago with arguments about whether the debt actually mattered. But gold did not attend the lectures and did not read the academic papers, and simply continued tracking the expansion of money supplies across the global financial system. Then, in 2020, a global health crisis arrived, and governments around the world responded by closing businesses, locking borders, and printing money on a historic scale. The Federal Reserve cut interest rates to near zero inside its marble headquarters in Washington, D.C., and announced it would buy unlimited quantities of government bonds. Congress passed spending packages totaling nearly $6 trillion within 12 months, and Treasury Department officials oversaw the largest peacetime spending expansion in American history. Stimulus checks were mailed from government offices across the United States to tens of millions of households as the money supply expanded at a rate not seen in generations. Gold climbed past $1,900 per ounce in the summer of 2020, and then broke through $2,000 for the first time in history, setting a new record on trading screens. The milestone was reported on financial news tickers running across screens in trading rooms, from Chicago to Singapore, but few mainstream headlines treated it as a major warning. Inflation followed the money expansion exactly as the historical pattern predicted, and grocery store shelves in American cities began showing price increases across every category. The cost of a dozen eggs, a gallon of milk, and a tank of gasoline at filling stations across Texas and Ohio rose faster than at any time since the 1970s. Federal Reserve officials standing at podiums in Washington, D.C., initially described the inflation as transitory and told reporters and lawmakers that it would pass quickly. But inflation did not pass quickly, and by 2022, the Consumer Price Index was showing annual inflation above 9%, the highest reading in more than 40 years. The Federal Reserve began raising interest rates aggressively from near zero toward 5% within 12 months. the fastest rate hiking cycle in the modern era. American homeowners watched mortgage rates on real estate listings double from roughly 3% to over 7%. And housing markets in cities like Phoenix slowed sharply. Gold pulled back slightly during the rate hiking cycle but refused to fall back toward pre-2020 levels because the underlying debt and money supply had not shrunk. The Federal Reserve could raise rates, but it could not easily reduce the $9 trillion balance sheet it had accumulated through years of bond purchasing programs. Gold understood something that quarterly earnings reports and stock market rallies could obscure, and that something was written across 5,000 years of monetary history. When a reserve currency nation accumulates debt beyond its ability to service through growth alone, the path forward narrows to a very small number of options. Those options are growth, austerity, default, or inflation. And the historical record of empires and reserve currency nations shows which option is most commonly chosen. Roman emperors chose inflation by shaving silver from coins. Spanish kings chose borrowing until lenders stopped lending. British governments chose inflation after 2 world wars. The United States national debt stood at approximately $34 trillion in early 2024, and the annual interest payments on that debt were approaching $1 trillion. $1 trillion in annual interest payments meant that the United States government was spending more on debt interest than on its entire national defense budget. That single fact, reported quietly in Congressional Budget Office documents published in Washington, D.C., carried more weight than any speech delivered from a government podium. Gold read that document and responded accordingly, and in early 2024 began one of its most powerful and sustained price advances in the modern era. Central banks from Poland to Singapore to Turkey were adding gold bars to their reserves at the fastest pace recorded since international tracking of such purchases began. The World Gold Council published reports from its offices in London, showing that central bank gold demand in 2022 and 2023 reached the highest levels in over 55 years. These were not speculative purchases made by hedge fund traders on Wall Street, but strategic reserve decisions made by governments planning for a world beyond dollar dominance. The shift was not happening overnight, but every ton of gold moving from open market vaults into central bank reserves around the world represented a quiet statement of caution. Gold crossed $2,100 per ounce in late 2023, setting a new all-time record on trading screens in New York, London, and across Asian financial markets simultaneously. Then in 2024, gold broke $2,300, then $2,400, then $2,500, then $2,600 per ounce in a climb that left many Wall Street analysts revising their forecasts. The price was not being driven by panic or speculation alone, but by a quiet and steady accumulation by institutions and governments that understood what the historical pattern meant. Every prior empire that reached this stage of the cycle had seen its gold price surge and its currency slowly lose the trust that reserve currency status requires to function. The question historians and economists were asking inside conference rooms and university seminar halls was not whether the pattern existed, but whether it would complete. Patterns in monetary history do not operate on fixed schedules, and empires do not collapse, according to quarterly calendars published by financial institutions on Wall Street. Rome took centuries to decline after gold first warned of trouble. Britain took decades. The speed of the modern financial system means the feedback arrives faster than ever before. But the destination that the historical pattern points toward has never changed regardless of the era, the technology, or the sophistication of the financial instruments involved. When a reserve currency nation accumulates debt it cannot repay, and its central bank expands its balance sheet beyond credible limits, gold begins its long and patient rise. The rise is not a prediction of collapse on any specific date, but a measurement of distance traveled away from the discipline that made the reserve currency trustworthy in the first place. A gold bar sitting in a vault in Zurich or Singapore does not know what year it is and does not read headlines published in Washington, D.C. or financial reports from Wall Street. It simply reflects the purchasing power remaining in the currency being used to price it, and as that purchasing power decreases, the gold price rises to maintain the balance. This is not a conspiracy or a theory, but a mechanical relationship that has operated across every monetary system in recorded human history without a single exception. The evidence is written in the price records of ancient Rome, in the account books of Florentine bankers, in the Dutch East India Company ledgers, and in British Treasury archives. Every single one of those civilizations believed it had found a way to manage money smarter than what came before, and every single one eventually discovered it was wrong. The United States in the 21st century has access to computer models, satellite data, artificial intelligence systems, and economic theory unimaginable to prior empires. And yet the gold price in 2024, climbing past $2,600 per ounce, was telling the same story that gold told in Madrid in 1620 and in Amsterdam in 1780 and in London in 1931. The story is not that civilization ends or that life stops, but that the center of financial gravity shifts, and those who understand the shift early navigate it more successfully. History does not announce its transitions with fanfare and press conferences, but communicates through prices, through trade flows, and through the quiet decisions of central banks. When the central banks of China, Russia, India, Poland, Turkey, and Singapore all simultaneously add gold bars to their reserves, they are reading the same historical text. That text was written by the decline of Rome and the fall of Florence and the retreat of Spain, and the long, slow fade of the British Empire from financial dominance. Each chapter of that text followed the same structure. First came money expansion, beyond what hard assets could support. Then came inflation. Then came the loss of trust. Then came the shift of financial power from one center to another and the rise of a new reserve, backed by harder assets and greater discipline than the one it replaced. Whether that shift is already underway or still decades away is a question that honest historians answer with humility, because the timing of such transitions resists precise calculation. What is not uncertain is the pattern itself, because it has repeated across enough civilizations and enough centuries to qualify as something closer to a law than a theory. Gold does not double before every empire falls as a prophecy, but as a measurement, and the measurement in 2024 and 2025 was recording one of the sharpest readings in modern history. The United States remains the largest economy on Earth, with the most powerful military and the deepest financial markets, and none of that is in dispute inside any serious institution. But size and power did not protect Rome, and did not protect Spain, and did not protect Britain from the mathematical consequences of spending beyond what their monetary systems could support. The lesson is not to predict disaster, but to understand that financial systems have weight, and when that weight exceeds what the foundation can carry, adjustments become unavoidable. Gold has been making that measurement for 5,000 years, and every civilization that dismissed the measurement eventually discovered that gold was not wrong, only early. The vaults at Fort Knox still hold approximately 4,580 tons of gold, and the Federal Reserve Bank of New York on Liberty Street still stores gold bars for dozens of nations. Those gold bars were placed there by governments that understood something which later generations sometimes forget and then remember again at considerable cost to their citizens. What they understood was that gold is not simply a metal but a record, a ledger written in weight and purity that cannot be inflated away by any printing press in any nation. That record today reads as a price above $2,600 per ounce and rising, a number that represents not just a commodity price but the accumulated verdict of monetary history. The empires of the past did not fall because their people were less intelligent or less capable than the people who built what came after them. They fell because financial systems have rules, and those rules do not negotiate and do not accept arguments from economists, politicians, or anyone sitting behind a podium. The rules simply operate, and the gold price simply measures, and the historical pattern simply continues, whether or not anyone in power chooses to acknowledge it. 5,000 years of gold bars, clay tablets, silver coins, and printing presses all point toward the same conclusion, sitting quietly inside every central bank vault on Earth. And that is the most important lesson that 5,000 years of monetary history has to offer to anyone willing to study it with honesty and without desire for a comfortable answer. The past still has stories to tell. Subscribe and let us uncover them together.